That's closing bell on Wall Street, and now it's Market Domination Overtime. We're giving you full coverage of all the moves to get you up to speed on the action from today's trade. Yahoo Finance's Jared Blickery joining us here to break it all down. Jared.
Thank you, Josh. No record highs to speak of in the major indices, at least on a closing basis. On the intraday one, we did hit a couple right after the open. Here's the Dow. We opened in the green territory, drifted into the red, pretty much stayed there all day. Not a big loss, so 0.2%, or not even 100 points. And then the NASDAQ down about 0.7%. We'll take a deep dive into tech in a minute. And the S&P 500 down about 0.4%. Meanwhile, small caps led the way down. Here's the S&P 600 down 1.3%. And we did have a record high. I got to show you gold right now. I know we've been talking about that a lot, especially with Yahoo Finance's and S4A. But there we go, 4,390. Finally cracked that big psychological barrier. And then in sector action, what is green is mostly defensive outside of financials. Staples was the best off, up almost 1%, followed by utilities, energy. Then you got financials and healthcare. To the downside, consumer discretionary led the way down. That is a Tesla story. Also, tech and industrials off more than 0.5%. And taking a look at the NASDAQ 100, not the prettiest of pictures. I would mention Tesla, that was down 4.45% there. Also, a lot of weakness in the chip sector. Let's just skip over to the semiconductors, and you can see some green there. Intel, ARM, Broadcom. I got to highlight AMD because over the last 2 days, they've tacked on, what is that, 28%. And this looks like a new record closing high for AMD, the first in about 1.5 years. So a little bit of green there. And then in software, also seeing a lot of red, some outsized underperformers. We got Nutanix down 6%, Ring, Zscaler, and Snowflake each down more than 3%. So some weakness there. And I just want to show you the Dow and the transports here. We do see green here. Dow has a lot more of these defensive sectors that we were just talking about in terms of staples like Procter & Gamble. Also healthcare, United Health up 1.4% along with Procter & Gamble. But here's the transports, the stuff that ships the stuff that the industrial's making. A lot of red here. Uber, the biggest one, down 28/100ths. And then UNP, the railroad's also not having a great showing today. And I'll leave it there, Josh.
Thank you, Jared. Well, gold officially topping the 4,000 mark as investors continue to flock to the safe haven asset. Yahoo Finance's Inez Ferre joining us now with the very latest. Inez.
Josh, gold is up more than 50% year to date, and the World Gold Council said that in September you saw record inflows into gold-backed ETFs, making a record for the quarter as well, with $26 billion in those gold-backed ETFs, led by North American investors, followed by European funds, followed by Asian funds. So all of this amid a weaker dollar, Fed easing expectations, geopolitical risks. That's what's been driving the price of gold higher over the last couple of months. And Wall Street is still bullish despite this big run up, because you do have strategists that have been calling for 4,000 by mid 2026. So quite a bit ahead of time. But you do have some bull case scenarios talking about gold hitting 5,000 by the end of next year. Now, having said that, there are quite a bit of strategists that have also been talking about the fact that it has run up very quickly in a short amount of time. If you were to see a pullback in the markets, you could see margin calling, you could see some selling off. And of course, if the dollar reverses course and goes materially higher, then you would see gold selling off in that scenario as well.
And Inez, while we have you, my friend, what about digital gold, Bitcoin?
Yeah, Bitcoin coming off of its all-time high from yesterday, and quite a tumble today. You saw Bitcoin down about 3% after going north of 125,000. It's north of 121,000 per token. Today's move may be some profit taking because you have seen Bitcoin doing a big run up really since the beginning of October. October being seasonally its strongest month. September wasn't too bad. It actually ended positive in September, but this is a month where it should be seeing some seasonal tailwinds. And we did see Bitcoin going up quite a bit over the last several sessions. The same scenario that you saw with gold being the backdrop of a weaker dollar, of Fed easing expectations, that's also been a tailwind for Bitcoin as well.
Inez, thank you.
Thank you.
Well, Well, the government is shut down, data releases frozen, and the Fed is flying blind. But with consumer spending and AI investments surging, the economy may prove to be unpredictable. Angelo Kourkafas, Edward Jones, Senior Global Investment Strategist, joining us now. Angelo, good to see you. So your advice to investors, listen, we were a bit softer today if you look at the popular averages, but your advice is, bottom line, you say keep calm and carry on. The outlook for stocks, you say it's positive. How come, Angelo? Walk me through that optimism.
Yeah, that's right. So we do have an uncertainty. That's a government shutdown and how long it's going to last. But at the same time, and it does impact people, many people, so we don't want to dismiss that. But when we do look at the three legs of the stool, as we call it, for the outlook for the markets, we have an economy that is still growing. We have corporate profits that are rising, and the outlook for interest rates is still lower. So when you put all these three things together, we do have a lot of support.
So earnings solid, economy's hanging in there, the Fed's cutting. What about valuation, Angelo? Because nobody's coming on my show and sitting in that chair and telling me, you know what, Josh, things are cheap.
Yeah, valuations are more demanding. There's no doubt about that. That is a risk. Of course, we all know that valuations is not a good timing tool. And also it depends on what the outlook is for interest rates. And the outlook is, again, for rates to go lower. Yes, we do have some demanding valuations for the mega cap technology stocks, but that is not the case across many different investments and asset classes. For example, US mid caps trade around the 10-year average, historical average. Small caps trade below their historical average. So as we think about the two main forces, we continue to have very strong demand for artificial intelligence and accelerated spending. But at the same time, with the rate outlook lower, we do have these more interest rate sensitive parts of the market that are getting more interesting now. So I think that's where you can still find some, I would say, fair valuations.
Let me ask you, Angelo, because you mentioned the government shutdown. And investors have sort of shrugged that off. And as investors, you're always kind of taught to shrug that off. You're always kind of taught, well, it's headline risk. It's not bottom line risk. Is that how you see this government shutdown, or are we being too complacent?
Yeah. We've seen plenty in the past. There's been 20 government shutdowns since 1976. And based on history, we know that they don't tend to leave a lasting mark on either the economy or the markets. One thing that is different this time, we have the potential for a prolonged shutdown and also the threat of permanent layoffs. So these two things could have a bigger impact, but typically the activity that is missed, it's been caught up, we catch up to that later on once the government reopens. And really, as we look at over the last couple of years, and certainly the last 12 months, what is really driving the economy? It has been a very resilient consumer and also a lot of spending to build out artificial intelligence. And these two things still remain in place.
You mentioned that AI spending boom. There have been, Angelo, some very well-known, well-respected investors who've been talking about that, and they've been kind of throwing in different ways kind of yellow caution flags. Ken Griffin, David Einhorn, Paul Tudor Jones. In different ways, you hear this talk bubbling up. Is it an AI bubble, right? Is there an echo of 1999? What do you make of that?
Yeah, the big difference is that a lot of these companies that are driving that, they are very mature, profitable businesses that are funding these investments from their cash from operations. They are not borrowing to make that happen. And as we think about, yes, there's going to be some winners and some losers. Not all of these investments are going to pay off. But at the same time, every single major company is trying to rewire their operating system to incorporate AI. So it does seem like we're still in the early innings of the adoption cycle. That said, we have to be selective, and really I don't think this is the time really to go down on quality. Still stick to quality and make sure that portfolios still have other exposures that may behave differently on different outcomes.
I want to end here on the Fed, Angelo.
Yeah.
The expectation, cuts are on the way. There are some smart economists who kind of say, well, hold on a second, inflation's running above target. It seems like it's kind of moving sideways, and that could give the Fed pause that maybe we shouldn't be betting on these cuts. If the Fed didn't cut, maybe as many times as we think or pencil in, what would that mean for the stock market?
that is a risk that the Fed may not deliver what is expected. At the same time, I do think that the direction of travel is going to be lower. The focus is going to remain on the labor market. So far, as you mentioned, we're flying blind in a way. We don't have the very critical economic data. We can still look at alternative data. The ADP private payers report may be the only one data point that the Fed has on the employment before they meet later this month to decide whether they're going to cut again or not. But I think we have plenty of evidence that the labor market is cooling and the inflation uptick has not been as much as feared. Remember, earlier in the year, a lot of concerns about tariffs and goods inflation. Yes, we have seen some of that come through, but not to the same extent that would really trigger a complete reassessment of what the Fed is going to do.
Yeah, worst case scenario doesn't seem to be playing out. Angelo, great to see you, especially on set. Thank you, sir.
Likewise, thank you.
From October 15th through December 7th, Medicare beneficiaries get a chance to decide on whether to stick with their current coverage or make a change for 2026. Yahoo Finance is looking at how to tackle this daunting decision in an upcoming week-long special of Decoding Retirement. And we have the host, Robert Powell, join us here now with a glimpse at what listeners can expect here. Bob, it is great to see you on set. Let's start with Medicare Annual Notice of Change, ANOC. For the uninitiated, start there about what is it?
Yep.
Why is it important?
Yeah, so if you're in a Medicare Advantage plan or a Part D prescription drug plan, each and every year around September 30th, you will receive either by U.S. Postal Service or by email the ANOC. And the ANOC details what are the changes coming to your current plan in 2026. So what happens to your premiums, what happens to your coinsurance, what happens to your copayments, what happens to your deductibles, what happens to your maximum out-of-pocket. And you get a chance to look at what it is now and what it will be in 2026. So it's really important that you look at that because you want to understand that if you stick with the same plan that you have in 2026, this is what you can anticipate in terms of changes.
Second question, the Medicare Plan Finder.
Yeah.
What is that?
So Medicare has on its website, they call it Plan Compare, but everyone calls it Plan Finder. And on Plan Compare, what you do is you enter your zip code, and then you search for plans that might be good for you based on your specifics, based on your doctors, based on your specialists, based on your hospitals, based on your pharmacies, based on the drugs that you take, et cetera, et cetera, et cetera. So what will happen is you'll enter all this information out, and then Medicare's Plan Compare will spit out a number of plans that sort of represent what you're looking for. And then you have to go through the hard labor of looking at all these plans and all the specifics and to see if any of those make sense to you based on premiums, deductibles, maximum out-of-pockets, et cetera. It's an arduous process. That's why we're doing this series.
Every fall, Robert, millions of people have to make these big Medicare decisions. Why is that such a confusing process exactly?
Yeah, because, first of all, most people who sign up for Medicare sign up for Medicare Part A, hospital insurance. Then you also sign up typically for Part B, and then for some people you sign up for Medicare Advantage, Part C, and then there's Part D. And then some people also sign up for something called Medigap. And just imagine those five
I'm already
things.
confused.
Yeah, it's terribly confusing.
Yeah.
It's terribly complicated, and oftentimes people make the wrong decisions because they get overwhelmed by the decision. So just one example. Let's say you want to go into a Medicare Advantage plan, and you live in a state like where I live, Massachusetts. I might see 40 different options to choose from.
Wow.
Right?
Yeah.
And then I have to evaluate because Medicare Plan Compare doesn't do this. It won't give me a spreadsheet that looks at what's the premium, what's the out-of-pocket, what's the deductible, what's the copay. So I have to do all this by hand, or I need to go get help from what's called a SHIP counselor, someone who's been trained to give you unbiased advice.
Are there any tips and tricks to navigating that, Robert, that you've found?
I think the biggest thing is it takes a lot of work, so don't be afraid of doing the work. I've talked to so many people who don't do it and then end up with the wrong plan. So don't be afraid of the work. And if you are afraid of the work, go to a SHIP counselor. So if you go to a senior center or your local library, there is someone there, you can do an appointment with them. You better book it soon and now because they book up early. From the moment they walk in to the moment they leave, their schedule is full. But go talk to a SHIP counselor. They'll at least help you sort through the options and maybe at least get you closer to what you want.
All right, Robert, great to see you, especially on set. Thank you, sir.
Appreciate it.
And be sure to catch the Decoding Retirement Medicare Open Enrollment week-long special starting October 13th. Well, Constellation Brands announced results for the second quarter on Monday, and Yahoo Finance's Julie Hyman sat down with an analyst from Citi who covers that company to break down the results.
So I think the expectations were already pretty low, and they came in about in line with what the market was expecting.
Well, I guess, Filippo, my main question for Constellation is, are its issues out of its control or in its control? And how's it doing with the things that it can control?
Yeah, no, that's a good question. I mean, look, I think a lot of it is really this global social political environment, is particularly how's it impacting the U.S. market and the Hispanic consumer, the core Hispanic consumer base. I mean, the company does like kind of like a quarterly omnibus study in terms of survey work with the Hispanic consumer base. That's about 50% of their consumer base. And based on this study, they're seeing that over 80% of consumers are worried about the socioeconomic environment in the US. And over 70%, they're particularly worried about their personal finances. So clearly the environment for them, it's really challenging, again, given over 50% of their consumer base is Hispanic consumers. And really what they're trying to do is really focus on their core brand, right? The Modelo Especial, the Corona Extra, try to launch innovation. But obviously the environment is not easy. They're still gaining share within the US beer category, but to a certain extent the share gains have clearly decelerated versus prior years.
So we've been talking about beer. There's also the question of what's happening in the wine and spirits category. They saw a big year-over-year decline, but that's because they also got rid of some businesses. So, but still saw a decline, even if you take that out. So that doesn't seem to be the sort of Hispanic market issue. So what does that have to do with?
Correct. The wine and spirits business is an area where they've been trying to diversify their portfolio in the sense of divesting the more mainstream brands, which have been declining by the larger amount, and they're focusing on the more upper end, the premium side of the portfolio. That part is doing still relatively better. But look, the wine and spirits category is clearly being under a lot of pressure. Overall alcohol consumption in the US has been coming down over this year and the past couple of years. So they do have pressures there as well. I would say they're trying to do the right thing from a portfolio standpoint, focusing on the part of the portfolio that are growing, but there's still quite a bit of more mainstream and lower income kind of exposure in some of the wine and spirits business that is declining still significantly.
And so I know you're neutral on this name. I mean, should investors sort of not really focus on anything alcohol related in this environment?
Yeah, look, our call has been more cautious on the alcohol category for 2025. We've been much more bullish on the non-alcoholic beverage side, especially in energy drinks, where you're seeing a lot of growth. In alcohol, you're really seeing decelerating consumption levels across the U.S., across different demographics, including Hispanic consumer, but also younger consumers. There was a Gallup poll a few months ago really suggesting that alcohol consumption has really been on the decline significantly for the past 2 years. And if you look through the survey results, it's really more pronounced in the younger consumer demographics. So clearly there are some concern about more structural issues for the alcohol category. And on top of that, for Constellation, the Hispanic consumer pressure has been really more than the industry given their higher exposure. So we downgraded the stock in March of this year because we thought the environment was going to get too tough for them to really continue their growth. Because prior to that, for the prior decades, from 2014 to 2024, they really had phenomenal volume growth, right? This was a company that was growing volumes at a high single-digit rate, and now they're declining more in the low single digits.
Well, I do want to ask you, Phil, about one of the biggest holders of the company that's been adding consistently is Berkshire Hathaway. And so sort of stepping aside from the sort of short to medium term outlook, we know Berkshire looks at the long term. Is there a long-term case to be made for this stock?
Yeah, no, look, it all depends on your time horizon, I would say. Our concern when we downgraded the stock was that this really socioeconomic environment, which is unfavorable for Constellation, could really last for a couple of years. So we were worried that, this was a company, again, coming from a decade of high single-digit growth, and so the market needed to reset to a much lower medium-term growth algorithm, which then the company cut its long-term algorithm in in April of this year. So if you take a little bit of a longer term view, like a 5-year view, call it, then you could argue, okay, some of this pressure among the Hispanic population will be generally more transitory, and this is still one of the fastest growing population within the US. And so if you take that longer term view and you say, okay, there's been a particular negative period of time where Constellation was impacted, on a more normalized basis, the company could return to positive growth. But I do still think the level of growth that you saw in the prior decade, the high single digits, seems very, very challenging to reach at this point.
Time now for What to Watch Wednesday, October 8th. Starting off on the Federal Reserve, we're going to be getting another big batch of Fed commentary on Wednesday. This is coming after comments from Fed Governor Stephen Miron on Tuesday. Miron saying he's not pessimistic about the overall economy, but that there could be lurking risks if the Fed doesn't adjust monetary policy. This all coming ahead of the Fed's next FOMC meeting at the end of October. And speaking of the FOMC, minutes from September's meeting will be coming out on Wednesday, giving us a detailed summary of what Fed officials talked about during their last policy meeting. Investors will be reading the minutes closely for clues about the Fed's path forward with interest rates. And finally, Wednesday marks 1 week of the government shutdown. Hundreds of thousands of federal workers are already being furloughed, while others are working without pay. By mid-October, federal workers, including members of the military, will start missing paychecks.